The Canadian dollar is at among its lowest point since the height of the pandemic, and before that, the last time that it fell below 72 cents was over a decade ago back in 2016. So although the Canadian dollar has regained roughly 3% in the short term as tariff threats have been tabled for the month, things still aren't looking up for the future of the Canadian dollar longer term.
The loonie is again trading below 70 cents US. That's the lowest point for the dollar in nearly 5 years.
It goes back really, a couple of decades if we really want to look at it.
Now, you might be thinking to yourself that the exchange rate doesn't really affect your daily life in Canada, but the truth is it impacts every single Canadian, whether you realize it or not. So let's dive into why that is, starting with how we even got to such a weak dollar in the first place. Alright, so there are many factors that come into play influencing why a country's currency will gain and lose value over time. And although it may seem oversimplistic, well, at its core, it mostly comes down to the fundamental economic principle of supply and demand driving currency fluctuation like pretty much every other market on the planet. And this makes perfect sense. When more people and businesses want to buy a country's goods, invest in its markets, or even purchase real estate due to strong economic prospects that the country is putting forth, well, they typically need to do so in that given country's currency, meaning they have to exchange their own currency into Canadian dollars in this case, driving up demand and in turn potentially also increasing the value of said local currency, Canadian dollars. Because remember, although it may seem like an abstract concept, an exchange rate is quite simply the value of one currency in relation to the value of another. So if more people and businesses are increasingly operating in the US market, let's say, well, this means there may be an increase in demand for US dollars, which in turn will increase its value relative to Canadian dollars. So the question then becomes, why would companies and investors want to place their capital into the assets and businesses of one country over those from another country? In this case, between Canada or the United States. Well, one key reason is the perception of stronger economic growth and prosperity on the horizon for a given country. Essentially, when investors and businesses see a brighter future for an economy, they are more likely to move their money there, purchasing up stocks, real estate, and private business interest, in turn boosting demand for its currency. And so the challenge Canada is facing right now is that its economic outlook is far less optimistic actually than that of the United States. The US's economy has rebounded much more aggressively in recent years, outpacing Canada's recovery and widening that gap between the two countries.
In 2023, the U.S. reported a GDP per capita of almost $65,000. That is compared to Canada, which is just over $45,500.
And to make this reality even clearer, here's some data comparing both economies as of Q4 of 2024. The US's unemployment rate was only 4.1% by the end of the year, while Canada's unemployment rate was 6.7%. Additionally, the US's annualized GDP growth was 2.8%, while Canada's annualized GDP growth was only around 1%, which is a big difference when we're talking scale of the economy. And finally, most striking is the difference in Canada's household debt levels, which is among the highest on the entire planet. A debt-to-income ratio effectively looks at how much the average person carries in debt relative to their income, with a debt-to-income ratio of 100%, for example, meaning that this individual is carrying the same amount of debt as they earn annually. And so although the debt to income ratio will vary greatly by state, well, the US's average debt to income ratio hovers around 82%. Although this graph shows that while total debt has been increasing over the years, the debt to income ratio has been on a steady decline as income growth has outpaced household borrowing in the United States. That is not the case though in Canada, with a debt to income ratio in Q3 2024 of a whopping 174%, which means that on average, Canadians hold around 1.74 times more debt than they earn on an annual basis, which is a huge problem for continued economic growth as Canadians are stuck servicing all of this debt, and in many cases, drowning financially. It is not out of the question in Canada for thousands of mortgage holders to be paying interest only on their payments as they've accumulated negative equity on their balances. So based on this data, it's clear that Canada's economy isn't really keeping pace with that of the US, which has significant consequences. A weaker economic performance makes Canada less attractive to foreign investors, leading to lower business investment and ultimately reduced demand for the Canadian dollar. And for the record, not only foreign dollars, even Canadian companies are going to be less inclined to invest in Canada rather than bringing those funds over the border. In fact, this chart featuring data from Statistics Canada and the Federal Reserve Bank of St. Louis provides a clear visual representation of how the two countries' economic trajectories have really begun to diverge over the past decade. Beyond Canada's economy showing weaker growth prospects, another key factor influencing the exchange rate is something called interest rate divergence. So the Bank of Canada has briefly acknowledged this as one of the contributing factors to the current exchange rate with the US, but only at the very end of its most recent economic outlook that it released a couple weeks ago, giving it less credit, in my opinion, than I think it truly deserves. Essentially, interest rate divergence refers to the gap between the interest rates set by different countries' central banks. Now, when one country raises its rates while another keeps them steady or even lowers them, well, this creates a disparity that can influence currency values, investment flows, and overall economic conditions. And investors are always looking to maximize returns on their capital. That's the foundation of investing. And most portfolios will include a mix of equity positions and fixed income positions, such as 5-year Canadian bonds or US Treasury bills issued by the government. The thing is, right now, 5-year Canadian government bond yields are around 2.8%, while 5-year US Treasury bills offer about 4.4% on an annual basis. And that represents a 1.6% spread and means that US Treasuries provide a much higher return, naturally attracting more foreign investment. And once again, well, as a result, demand for US dollars increases and strengthens its value relative to the Canadian dollar. But why is this happening? Well, it all comes down to bond yields following the underlying interest rates set forth by the Federal Reserve in the US and the Bank of Canada in Canada. Over the past 12 months, the Bank of Canada has cut rates by a total of 2% in an effort to further stimulate a lagging economy. On the other hand, the US tells a very different story. With a robust and growing economy to begin with, well, the Federal Reserve hasn't had the same need to slash interest rates to the same extent in order to keep growth steady and on track. So this divergence in monetary policy directly impacts bond yields and in turn currency demand, as we're now seeing unfold. Now, it should be noted that initially the US was expecting more interest rate cuts on the horizon in the second half of 2024, but with Donald Trump back in office as well, now there's a much stronger sense of economic optimism in the country, which prompts investors from really all over the world to see this unfold and want to invest in the US stock market, which requires US dollars. And this shift in outlook suggests that the Federal Reserve may not be in a position to cut rates as aggressively as it might have been under Joe Biden's administration, further reinforcing that gap between the US and Canadian interest rates, which may very well widen even further throughout 2025. Plus, throw in tariff uncertainty, and this makes things even more unpredictable. All right, so we now understand how and why the dollars lost so much value over the past couple of years. But on a practical level, who will this weakened currency impact the most? Well, for starters, any Canadian traveling to the US will feel the impact of the exchange rate the moment their credit card transactions go through. And on top of that, conversion fees that are added as an extra layer of cost make every purchase even more expensive in the US. For example, here's a charge on my Amex for 3 slices of pizza that I purchased during my recent trip to New York City at a restaurant called Lindustry Pizza. The charge itself was only $18.78 in US dollars, but it landed on my Canadian card at $27.62. Basically $10 a slice in Canadian dollars. Brutal. This exchange rate shift affects all Canadian travelers, of course, but it'll especially impact snowbirds who spend extended periods of time in the US each year. Whether it's booking accommodations, dining out, buying groceries, every expense becomes noticeably more costly. So for those who regularly escape to warmer climates, the weaker Canadian dollar can put a very significant dent in your travel budget. But even if you're not traveling to the US anytime soon, the weak Canadian dollar affects nearly everyone, as everyday essentials like food, books, electronics, and vehicles, many of which are imported from the US, become more expensive at their core. And that's before even taking into account the potential price increase that we could see from tariffs on US goods if that does end up materializing next month. So with this in mind, since Americans already earn significantly more on average than Canadians do, even when equalized in the same currency, well, the cost of living in Canada is actually much higher for the average person. Think about it. As of 2024, the average salary in Canada was $67,282, which if we were to convert to US dollars right now at the current conversion would be around $47,300. In contrast to this, the average income in the US as of 2024 is $63,795 US dollars, which is a huge gap in regards to average wages in Canada, especially considering many expenses like housing, rent, utilities, vehicle, food, and basically everything else are more expensive to begin with in Canada. And like I said, if a trade war comes into play, things could get even worse. Now, the Canadian dollar has briefly strengthened when US tariff threats were paused, but even if we avoid them entirely in the coming weeks, Canada still isn't in a strong position to see substantial currency gains longer term due to what we just spoke about earlier. That's ultimately what's important here, due to the underlying economic challenges that we discussed. What's more is that small businesses that heavily rely on US trade will also feel the pressure of the FX conversion. And while some may try to pass higher costs onto their customers, well, that's not always an option, as customers could choose to shop in larger box stores, which tend to have economies of scale and more complex supply chains to stabilize prices. Ultimately, many companies facing the reality of doing business with a weaker Canadian dollar, making operations more expensive overall, may decide to even relocate to the US, which already offers a more business-friendly environment in regards to legislation, corporate options, taxes, and, well, a much larger market as well. All right, now a weak Canadian dollar is generally not going to be seen as a good thing for the country. However, in some small instances like tourism, it could actually have a net benefit in increasing the volume of traffic in the country, as, say, Americans looking for a summer getaway may look north of the border to spend a couple of weeks skiing or exploring Atlantic Canada. With their dollar going so much farther than in the US even, it would be like a trip costing 70 cents on the dollar. Sign me up. Additionally, a weaker dollar means that exports may suddenly become more attractive for foreign countries, the US and others alike, which could boost overall exports out of the country and increase GDP. That is, if Trump tables the tariff idea, which realistically would nullify any cost savings on currency divergence that US firms would be able to capitalize on. In fact, we already looked at the impacts US tariffs could have on our exports to the US and therefore our GDP growth moving forward. It's in our best interest to fully avoid this situation while still keeping it in the back of our minds as a reminder that we in Canada need to expand our export network to other countries more heavily. And from here on out, in the short term, we're seeing the Canadian dollar having gained some value relative to the US dollar, resulting from slightly higher confidence for now, but longer term, the FX rate will entirely depend on Canada's ability to once again gain momentum in economic output in relation to the US's growth, which might be easier said than done. If you enjoyed today's video, make sure to drop a like and subscribe to the channel for more economic and financial videos in the near future. Additionally, if you'd like to start investing in the stock market, highly recommend you check out my 100% free to watch course over on Skillshare. It has over 3,000 students and 7 hours of content. Plus, if you need to open an investment account, TFSA, RSP, or regular investment account, use the link down below in this video's description to get a fantastic sign up bonus when you open and deposit money into your new Moomoo account. Thanks a lot for watching. Check out one of these two videos right here, and I'll see you in the next one.